Manager with AVATAS Payments. And again, thank you very much, Ted, and the PPA for hosting the webinar series and for the opportunity to participate. Also, a big thanks for all of you who have jumped on the line here and taken time out of your day to join this webinar. Today, we're talking about preparing your payments for the winter. As Ted mentioned, please do not hesitate to fire off questions during the presentation, and I promise to address all questions. And if for any reason we run out of time or you must leave before the Q&A, I'll follow up with you to ensure you get your answers. So why is it important to prepare your payments for the winter? Your business is you're in the business of keeping people warm. Folks are firing up their furnaces for the season. 75% of your annual gallons of fuel will be delivered over the next 5 months. That also means 75% of your payment processing costs will be incurred as well. There are some simple things that fuel oil dealers can do to ensure that profits aren't going to be going up the chimneys of their plastic paying customers. Now it's time to make sure you have your payment affairs in order and keep the cash flow in the business while your gallons spike. It's just one more item to put on your to-do list. My furnace just kicked on. I can hear the water running through the pipes now, so I know a lot of your homeowners are doing the same thing as well. Your trucks have been serviced, your supply contracts have been signed, you've staffed up to handle the increase in demand. Electronic payments are an important part of your business that you should not ignore. Couple quick things you should do when reviewing your electronic payments. First, you should be taking a look to see if your account is set up correctly. How much are you paying to process credit cards? How are you taking the cards currently? Is your customer data and your business protected? And have you ever thought about how payments impacts your customer experience? What do I mean when I ask if you're set up correctly? There's a couple of things that go into that. There's many ways a company can price your account. There's tiered pricing, there's ERR pricing, Interchange Plus, and that's just to name a few. Credit card processors have gotten very creative on how they advertise and display pricing, and I think it's by design to keep you guys confused. If you're not set up with Interchange Plus pricing, your account's broken. It isn't always easy to decipher on your statements to see what pricing model you have. One quick thing is to take a look in your statement. If you see descriptors on fees like qual, mid, and non, that's definitely something that should raise a red flag with you. If you're unsure, reach out and we can definitely help you figure out quickly if you're set up with Interchange Plus pricing. By being set up with Interchange Plus pricing, you'll have access to take advantage of the extremely low utility rates offered by MasterCard and Discover, as well as the emerging market rates offered by Visa. Not just any business has access to the lowest possible pricing like the utility category, and not all providers out there know exactly that you qualify for it. It hasn't always been a thing that you guys have been able to get access to the utility rates. It's only been about a decade or so. So a lot of times if you go to a credit union or a local bank, they may not know the specific needs of your business type as it relates to utility. To qualify for the utility category, you need to ensure that you have the correct MCC codes for both MasterCard and Visa. There are more than one MCC code that could fit your business, so usually companies might not do the correct one. You want to make sure the provider is aware of the specific needs. If not, it could cost you thousands of dollars in increased processing costs by selecting the wrong MCC code that's not tied to the utility and emerging market rates. Card mix has a huge impact on how you pay, how much you pay for processing costs. You've got 4 major card brands, and you may not have a direct impact on what your customers pull out of their wallet when they go to pay you. But there's small, simple things you can do to help shift some of that payer behavior. For example, a $400 delivery of fuel costs approximately 65 cents on a MasterCard transaction that qualifies as a utility. That same transaction of $400 if paid with a Visa card, the emerging market rate is going to be about $6 more than that. There are some things you can do to impact that card mix. It could be as involved as running a campaign to offer a few pennies off the gallon for auto pay customers who change their payment method from Visa to MasterCard. Or as simple as training your CSR reps when taking payments over the phone to ask for MasterCard. Just simply ask, would you like to pay with a MasterCard today? This is an organic way to add savings to your account. Some other drivers of extra costs are using things like pre-authorization. I understand why some of my clients swear by it and don't mind paying a little more to have their payment protected. But if it is something you may want to review, that policy and what alternatives are available while you go into the heating season. Not entering enough information or delays in closing out your batches will also incur avoidable fees. In short, go through, review your payment policies, train your staff to ensure they're entering and settling transactions correctly to not inflate those processing costs. Payment processing is complex. You'll drive yourself crazy if you try to dig into each individual cost and fee and make sense of it. The best way to gauge your performance when it relates to payment is to understand your blended rate. This is the total amount you pay divided by the total volume you ran. It will vary month to month based on the card mix, seasonality, etc. There's a lot of factors that go into each month. You take on a big client that uses a corporate card, that might spike that blended rate up a little bit. Or if you have a big month with a lot of MasterCard payers, that's going to bring that blended rate down. The blended rate is your barometer for performance of payments. Understanding your average blended rate over a period of time will give you the ability to understand if something's out of whack. Typically, when we're doing a review, we'll take a look at 12 months of processing and we say, okay, so in January, you were processing around 150 for a blended rate. In March, you went to 175. And February was down at 1.25. What you want to do is take a running tally of whatever it is, 6 months or 12 months, and get an idea what that average blended rate is. That way, each month when your statement comes in and you take a peek at it, you'll know pretty quickly if something's out of whack or needs to be dug into. All of a sudden, you have a 2% month of blended rate, but you're typically around a 1.5 or a 1.4. You know something's wrong, or something came in that affected that card. So you want to dig in a little bit and find out what may have happened. Could have just been that you took on a new corporate client, or it could have been that someone decided to pay with an American Express card and it was a large transaction. Things like that you want to be able to identify quickly so that if you see a slight increase in that blended rate, it's not freak out mode and they raise my rates. It could just be that it's the nature of the beast and it's an average. So you want to take a look at that average, get a good idea of what it looks like. And that is, I think, one of the biggest things to take away from here, because so many people call me and say, what am I paying for Visa? What am I paying for MasterCard? How much am I in Express transactions? That's important if you want to get into the nitty-gritty of it, but what it really boils down to, overall, how much did I pay? That way, if a large corporate client comes to you and says, I'd like to pay with my credit card on this very large transaction, and you want to add some sort of convenience fee to it, you don't have to think, well, how much does that specific card cost me? You can just go to your blended rate and say, okay, I'm going to build this into my costs to help offset some of those increased fees. Switch gears away from costs. You want to take a look at what you're doing to keep your customers' data secure. And in turn, it protects your business. If you have cards on file, how are you storing them? If you're allowing customers to pay on your website, are you securing yourself from a bot attack? A bot attack finds a vulnerable website and uses it to test stolen credit cards. Simple things like using an encrypted vault will keep your customer data protected. And simple best practices while questing address match on your web transactions or setting up a recapture fraud protection tool will help combat fraud via your website. I'm happy to discuss any security postures and find ways to help protect your business. But when it comes down to it, one of the things that we're seeing frequently that I think you want to take away from this is keep an eye on your website. If just anybody can go onto your website and make a payment, that's leaving you vulnerable to an attack. And when I mean a bot attack, that's when you've got someone with 1,000 stolen credit cards or 20,000 stolen credit cards, and they're going to use your website to try to test them to see if they're valid. If they're valid, that criminal can go sell those at 10 times the cost of a non-validated one. So you might see 10,000 transactions for $1 or $2 or whatever it is fly through your account overnight. Keep an eye on those things because you want to get ahead of it. We can void them out. We can protect you from it if it doesn't go too long. If it goes past the point of batching out, now you're running into potential chargebacks and other issues and costs related to it. So you want to make sure that when you're processing on a website, you're doing some simple things to help keep your business protected. The payments are changing, technology is changing, and your customers are changing. In the world we live in today, it's more important than ever to make it easy for your customers to pay you. We understand your customer base is made up of customers across all generational demographics. The millennials are getting older, and they're buying houses off the older generations that are moving to warmer climates. The millennials are a generation of folks born in the cell phone age. The world has been shaped by technology. These kids don't have checkbooks. They're used to news in real time, getting from point A to point B in real time, buying paper towels online with the click of a button. Not even pulling out a credit card anymore, let alone a wallet. Millennials are taking over, and you want to make sure that your acceptance methods are up to snuff to meet their expectations of easy transactions. Know your customer base. Your baby boomers are going to be your loyal customers. They prefer full service. They don't care if you're 40 cents more than the next guy. Your kids probably went to school together. The generational X folks, they're cost-conscious ones. They'll shop you around to save a buck. The millennials, their sweet spot is ease of use. Do you offer mobile payment processing options for service calls? Can you send electronic invoices? Can your customers go onto your website, pull up their account, and make a full or partial payment on their account? Do you have account updated to automatically update the expired credit cards? Are your in-house terminals ready to accept Apple Pay, Samsung Pay, Google Pay, and all the other pays that are coming along down the line? And do you offer all types of cards and electronic checks? It's about giving options and making it easy. And some people try to stay away from maybe taking American Express because they think it's more expensive, but it's one of those cards that a lot of people are loyal to it, of all generational demographics. So sometimes it's good to just have that card in your back pocket, even if you don't advertise it because of the perceived higher cost. But like we mentioned before about that blended rate, most times when I see accounts that take Amex and then put it next to one that doesn't take Amex, that blended rate doesn't go up that much. So it might be worth taking it since you might be able to gain more customers by having it. One other thing about this section of customers, the millennials, typically, or a lot of them, are strapped with debt. And many of them live paycheck to paycheck. So look to incentivize this segment of your customers to get them into a budget payment program or recurring payments to ensure that you're making it to the top of their financial obligation list, above the beer money and above the sushi. Tools like that can help. If all this fails, I recommend working with a third-party collection company that can make you a creditor. The millennials need to prioritize their bills, and you will certainly get paid faster if they know you will show up on their credit report as delinquent versus getting a pink envelope with no backbone that's going to go right into the trash can until their tank runs dry, of course. So in wrapping up, what you want to do, it's getting cold out today. It was 70 degrees yesterday. It's probably 40 degrees today. So we're heading in that direction. So you've got a little bit of time, but I know you guys are busy getting ready for the season. And once that temperature drops below freezing, it's straight out until we see you again probably in April. So review your accounts prior to the spike in gallons. Take a look at the payment tools that you're using. Are you giving the millennials easy options to pay you with? Turn those transactions into interactions. Look at each segment of your group. If you're millennials like ease of use, great, make sure you have it for them. If your baby boomers like the loyalty, just keep doing what you're doing. And for everybody else, find ways to make sure that you can retain them as customers and keep them filled up with fuel and keeping them warm. So think about what your customers want and utilize the tools that can attract new customers as well as keeping the ones you have. And that's pretty much what we've got for preparing your payments for the winter.
Dan, thank you very much. We did have a few questions come in, and anyone that got on the webinar late, you can ask a question by just typing it into the chat section of GoToMeeting. But just to jump into the, we had a handful here. Excuse me one second. In terms of security, what is the best way to determine if my current processor is providing a secure solution?
Well, security is a few different things that you could kind of do, and one of them is asking for their attestation of compliance. Visa and MasterCard have what's called PCI compliance. I know you're all aware of that term. You're all dealing with it on an annual basis. AVATAS and other companies that are doing what they can do to keep their customers safe will be part of this attestation of compliance, and you can find them on Visa and MasterCard's websites listed there. I'd be more than happy to send along where you can find those links, but it's something you can take a look at online to make sure that your provider's compliant. And then as far as the tool is concerned, you want to think about vault technology to keep your customers' data safe. So if you're storing data, you don't want to store that in your back-end software. You don't want to store that in a shoebox. You don't want to store it on an Excel spreadsheet. You want to store that information in an encrypted manner. And most gateways have some sort of vault or encrypted technology to keep that data safe.
Very good. We just had one come in here in regard. You referred to automatic or setting it up your credit card so if one expires or is no longer valid, you can automatically update that. Could you just talk through that process?
Sure. Well, the benefit here is not only saving time for your CSR reps, right? Because they got to track down expired credit cards when they're coming up. One of the downfalls for a customer is that they may not know their card's going to expire, and all of a sudden their transaction declines. The next thing you know, you're chasing them for a payment, thinking that they're a delinquent payer, and it's just a bad experience. So what's available is a program called Account Updater, and it pings the card brands, and it basically gets the updated expiration information and possibly the updated card information. Some card numbers change when the expiration date goes bad. And it puts that back into your vault system and updates the token. So CSR reps don't have to make that call. The recurring payments can continue, and the customer experience is smooth. They have no idea that anything ever happened on the backside. Typically, this is driven from the gateway you're using. We use authorized.net and the AVATAS gateway, which is an NMI gateway, and these both have account updater functionality in it. Some gateways make it easier for you to enroll and have little to no costs, and other gateways have some setup costs and individual costs involved as well. So you want to take a look at what your gateway is and find out what options they have for account updater.
Very good. Another one we just got in here. Is there an extra charge for pre-authorization? Yes.
So when you pre-authorize a card, just so that we're familiar with the term and what it actually means, we'll level set it here. Pre-authorization is when a driver is going out to drop some fuel. You don't know how much fuel's in the tank. You don't know how much you're going to be putting into it. You don't want to get stuck not getting paid. So you want to run a transaction to capture those funds ahead of time. The tank holds, say, $500 worth of fuel, so you run the card for $500, putting a temporary hold on those funds. And then when the driver comes back and reconciles, you say, okay, I put $375 in, and you can readjust that authorization for the correct amount. So there's a preconceived notion that doing it this way is better for the customer because it's not going to hold their funds. But in reality, when you do a pre-authorization, it does limit the ability to use those funds in the bank account. And depending upon whether it's a debit card or a credit card, it could take 1 to 5 days to maybe even 10 days to get that money back on that person's card after the pre-authorization has been adjusted. The nice thing is that you do know that you're going to get paid for those gallons that you're dropping off, but there might be some alternatives, like just running a $500 transaction and then running a return or a credit on the balance that wasn't taken by the tank. The cost involved with doing a pre-authorization is it causes your transaction to downgrade. And when I say that, this is not getting into the weeds of all the little individual costs that are involved, but instead of getting a nice low 65% rate for a MasterCard, if you pre-authorize it, you might actually see a 2% charge on that MasterCard. And it could vary based on the card type. So there's not a set fee that says a pre-authorization costs you X. It's going to make your transaction downgrade and drop to the next tier that's below it based on what card that is. So it does increase costs, and it's something that if you're doing it now, take a look at what your blended rate is. And if your blended rate's in check with what you think is reasonable, then don't worry about it. But if it's causing you to pay more than 2% for processing or the high, 1.8, 1.9, 2.0, that could be a reason why. And maybe there's some practices you could put in place that would bring that cost back down so you can qualify for the best possible rates.
Very good. In terms of the utility classification, does our service department qualify for that?
It can.
As in HVAC service.
Yep, it can. Technically, the answer is not really, because an HVAC is not the delivery of fuel. However, most companies run them under the same umbrella. I know my company has a service wing of it, and it's one and the same business name. We set two accounts up so they can keep their banking and financials separate for the two entities, but they're under the same oil company name. So in that case, we're going to set them up as utility. So yes, you can typically qualify to get the best rates on all your transactions, but it all depends on how it's set up. Like if you have ABC Fuel, and then you've got ABC HVAC, yeah, ABC HVAC may be hard to get across as utility because it doesn't have fuel in the name. So it's kind of all on how you set the accounts up to see if you can massage it into being able to accept those utility rates as well. And it's important if you can, because obviously the service side has some pretty high tickets, and that percentage rate can add up if you're just processing like every other business does with Visa and MasterCard interchange.
Next one we got, what's the best practice for applying a convenience fee when charging customers?
Well,
or covering the rate of the card.
Depends if you're doing it across the board or if you're doing it in a one-off situation. And some states have regulations on how you do convenience fees and surcharging and things of that nature. I don't think Pennsylvania is included in that. I know there's some non-Pennsylvania customers on the phone, so feel free to reach out and we can take a peek to see if there's any restrictions around convenience fees for you. If you're doing it across the board with the AVATAS gateway, you can set up a functionality in there to add a line item for convenience charge. So if you have, say, $100 in fuel, you're not just charging 103, you charge 100 for fuel and 3 for convenience charge, and it line items it and subtotals it. If you're doing it on a one-off situation where you have a large client who says, hey, I'd like to get into a contract with you to deliver fuel to my apartment complex, and it's going to be X amount of gallons per month. I'd like to put that on a credit card. I would just behind the scenes kind of build that into your pricing, so it's kind of just offset in there and not really labeled as a convenience fee, but it's just part of the proposal. So there's a couple different ways you can look at it based on how you're trying to implement convenience charges to your base.
Very good. Next one's a pretty direct question. Why is it so hard to get a straight answer from processing companies on what my actual rate is?
Well, that's because it's complex. Payment processing has lots of costs and fees. There's a lot of fingers in the bucket. You've got the card brands like Visa and MasterCard and Discover and Amex. You've got the card issuing banks like Chase and Bank of America and Sharon Credit Union. And then you've got the payments providers as well as security fees and other things that have come into play. So when it comes down to what's my rate, everyone's wondering, what's my rate? And you don't have one rate that encompasses everything. And that's why I really stress getting a real good finger on post for what your blended rate is. Because when it comes down to it, you guys are in the business of delivering fuel, not payment processing. So unless you want, a 101 on payment processing fees, all the minutia of what your rates are for each individual card is not important. It's how much you're paying overall. And that overall blended rate will shift you to say, okay, I'm either performing well here and I'm paying a inflated amount, or I'm paying, industry standard, or I'm paying below industry standard. And we can kind of help you figure out where you stand if you'd like to do a rate review. But there is not one single rate. The card brands and everything else involved makes it very complex. So when you have a company coming in and saying, I can lower your rate, I can lower your rate, I can lower your rate, well, they're just trying to get you to listen to them. And when it comes down to it, call your provider up and just say, my blended rate is here. My card mix, what's my card mix look like? What are the things that I can do to help bring this blended rate down? And I wouldn't worry too much about what your rate is, unless you go with an aggregator like a Square or PayPal, which really isn't built for your industry. That's more for crafters and part-time sellers and things like that. They have a flat rate of about 3%. So you can go to something like that and have a rate, but it's going to be much more than what you can get by going through the traditional utility rate categories.
Okay, and we're going to end with one more question, which kind of leads into what you're saying here, Dan. What is the differential, or at least try to describe the differential between the typical rate versus that utility rate? And I guess whoever asked this question is asking that in terms of cost.
Sure. Well, the utility rates, when you look at that, is you're going to have a wide variety of rates coming across, even with utility category, because different card types are going to shift where the percentage rate falls. With utility rate pricing, you're typically going to see the majority of your MasterCard transactions are going to have a flat 65-cent interchange cost. If you're set up properly with Visa, the emerging market rate is a 1.43%. Those are the best rates you're going to see on MasterCard and Visa. Discover is the same as MasterCard, around 65 cents. And American Express has nothing to do with utility. You're going to pay whatever American Express people pay, no matter who you are. So if you're not set up properly with utility rates, your average rate on MasterCard would probably be closer to 2%, 1.89, 1.79, somewhere in there. Business and corporate cards are typically somewhere between 2.5% and 3%. You can still see 2% and 3% cards if you're set up with utility, but it just should be the minority of the transactions coming through. If you're a wholesaler, if you're not your typical residential fuel marketer, wholesalers, they can still see utility rates, but they've got a lot of different stuff going on because of the size of the transactions and the nature of those transactions. So if you're a wholesaler, or if you have a wholesale division and a residential division, those two aren't going to match up, line by line. You're going to see lower pricing with your residential than you are with your commercial. Hopefully that answers
very good.
Question. If not, happy to elaborate on any of these after the fact if you need more clarification.
Awesome. Well, Dan's information is on the screen. If you don't have it or you want to get it for something you can't see it, please reach out to me directly and I will connect you. But other than that, Dan, thank you very much, and thank you everyone else for getting on here this morning. We're going to wrap up at this time. So thank you again.
Thank you. Hey, here's to a cold and long winter.
Absolutely. All right, everyone, take care. Thank you.
Bye-bye.